The traditional playbook for expanding a Bitcoin mining operation has been unchanged for over a decade. Buy machines, secure power, and deploy quickly. But in the wake of the latest halving, that playbook is no longer reliable. Revenue per unit of hash rate has dropped by more than half in less than a year, and the margin for error in capital deployment is nearly gone. In this new environment, mining operators are rethinking how they scale. Owning ASICs is still central to most operations, but access to flexible hash rate is becoming a valuable tool, especially when timing, uncertainty, or short-term opportunities come into play. A two-layer model is emerging. The first layer is owned infrastructure, ASICs, facilities, and power agreements, which supports long-term strategy and consistent production. The second is variable hash rate, sourced on demand from marketplace liquidity, allowing operators to adjust exposure without expanding their physical footprint. The most successful operators in this cycle are managing both layers. The cost of waiting is easy to underestimate. On paper, evaluating mining hardware looks straightforward: machine price, expected output, power cost, and break-even estimates. But in reality, the timeline is less clean. Between ordering most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. Fleet and hashing, multiple steps must align. Procurement, shipping, customs, site readiness, rack space, power allocation, firmware configuration, and pool integration. Even well-prepared operators run into sequencing issues where machines and infrastructure are ready at different times. That gap carries a real cost. A 100 PHS deployment delayed by 60 days at a hash price of $28.30 per PHS day implies roughly $168,000 to $180,000 in lost gross. That's a significant sum in a market where margins are thin and competition is fierce. When operators source hash rate on demand, they avoid many of these delays and uncertainties. Instead of waiting for hardware to arrive and be deployed, they can activate hash rate instantly through liquidity pools or marketplaces. This gives them the ability to respond to price swings, network difficulty changes, and market conditions with agility. It also allows them to test new strategies without long-term capital commitments. The shift is not about replacing ASICs, but about complementing them with a more flexible resource. This is particularly valuable in a post-halving environment where revenue per hash rate is volatile and the cost of waiting is high. Operators who can balance owned infrastructure with variable hash rate are better positioned to manage uncertainty and maximize returns. However, this model is not without risk. Hash price volatility means that the cost of sourcing hash rate can fluctuate rapidly, and operators must be prepared to manage that risk. Additionally, reliance on third-party liquidity introduces dependency on market conditions and platform availability. If a marketplace becomes congested or a provider goes offline, operators may lose access to hash rate at critical times. Still, for many in the industry, the benefits outweigh the risks. The ability to adjust exposure without adjusting physical infrastructure is a powerful advantage in a rapidly evolving market. As the industry continues, most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. To adapt to the new normal, the line between owned and sourced hash rate is blurring. Mining operators are no longer just choosing between buying machines or buying hash rate. They're learning to use both in a coordinated strategy. This shift is reshaping how mining operations are structured and how operators think about scaling and risk management. The next signal to watch is whether hash price volatility continues to widen and whether liquidity platforms expand their offerings to support more flexible and automated hash rate sourcing. If these trends hold, the role of hash rate buying in mining operations could grow significantly.